Welcome and thank you for standing by. At this time, all participants will be on a listen-only mode for the duration of today's conference. This call is being recorded. If you have any objections, you may disconnect at this time. I would now like to turn the call over to Ms. Alicia Criado. Thank you. You may begin.
Thank you. Good afternoon, and thank you for joining the Consumer Financial Protection Bureau for today's overview of the Know Before You Owe mortgage rule, also known as the Truth in Lending Act and the Real Estate Settlement Procedures, TILA-RESPA, Integrated Disclosure Rule. Again, my name is Alicia Criado, and I work in the CFPB's Office of Community Affairs. Today's webinar is part of a continued effort to provide Americans with information about the Bureau's resources and tools. Today's session is specifically designed for housing counseling agencies that provide pre-purchasing assistance. That said, we've received over 600 RCPs for today's session. And many thanks to those of you who helped spread the word about today's webinar, and of course, thank you all for joining us again today. I'm joined today by a few of my colleagues from the Bureau's Research, Markets, and Regulations Division. Julie Vore, who is an Originations Analyst in the Office of Mortgage Markets, and Pedro de Oliveira serves as Counsel in the Office of Regulations. They'll be providing an overview of the available resources for housing counselors, background information of the rule. They'll also be walking through the new mortgage disclosure forms and provide a brief tour of the CFPB resources available to housing counselors and their clients. Before I hand the webinar over to Julie, there are some housekeeping items that I would like to mention. First, this webinar is for educational purposes and off the record. If you're a member of the press and have joined this webinar, please take the moment to disconnect. Second, as the operator mentioned, today's webinar is being recorded. The presentation portion of today's session will be posted to our website and available to the public. And third, all participant phone lines are muted and will be in listen-only mode for today's session. Once the staff members have completed their presentations, we'll begin the Q&A component. We did request that questions be submitted in advance of today's webinar, so thanks to those of you that submitted your questions. We'll be encouraging everyone else to use the chat function and send questions to me, Alicia Criado, using your chat function under the Q&A tab. Again, we will try our best to answer questions that are submitted to the best of our ability. And lastly, please ensure that you're viewing today's webinar in full screen mode. You can change the view to full screen by clicking, there's a toolbox on the bottom of your current display, and if you hover, it's a small screen that will prompt you to open your current view to full screen mode. With that, I will hand the webinar over to Julie.
Thank you, Alicia. Pedro and I are both a part of the Know Before You Owe mortgage implementation team, and we're happy to have this opportunity to be with you here today to talk about how homeownership counselors can take advantage of the Know Before You Owe initiative, and particularly how to work with the new loan estimate and closing disclosure. Before we get started, I want to go over this first slide titled Disclaimer. This is the same disclaimer that always applies to our presentations. This is a reminder that while we are here to be helpful, ultimately the rules do speak for themselves. We cannot change their meaning through webinar or other means outside of the notice and comment rulemaking. The Bureau issued the TILA-RESPA Integrated Disclosure Rule in November of 2013 to implement provisions under the Dodd-Frank Wall Street Reform and Consumer Protection Act. The Bureau issued amendments to the TILA-RESPA Integrated Disclosure Final Rule in January of 2015. The final rule will take effect on October 3rd, 2015. This presentation is current as of today, July 28th, 2015. This presentation does not represent legal interpretation, guidance, or advice of the Bureau. While efforts have been made to ensure accuracy, this presentation is not a substitute for the rule. Only the rule and its official interpretations can provide complete and definitive information regarding requirements. This document does not bind the Bureau and does not create any rights, benefits, or defenses, substantive or procedural, that are enforceable by any party in any manner. Having said that, I want to go through some background. I first want to talk about what the Know Before You Owe mortgage initiative is all about. It is designed to empower consumers with the information they need, when they need it, to make informed mortgage choices. The Know Before You Owe Mortgage Initiative includes the TILA-RESPA Integrated Disclosures Rule, which is often referred to as TRID. We prefer Know Before You Owe, and since getting past industry jargon is a first step, we think you might prefer it too. The Know Before You Owe Mortgage Disclosure Rule primarily does two things. One, it simplifies and consolidates some of the required loan disclosures. And two, it changes the timing of some activities in the mortgage process. In November 2013, the Bureau finalized amendments to Regulations X and Z that integrate the Real Estate Settlement Procedures Act, RESPA, and the Truth in Lending Act, TILA. These rules will take effect on October 3rd, 2015. The initial Truth in Lending disclosure, the initial TIL, and the RESPA Good Faith Estimate, the GFE, are combined into the new loan estimate. And the final Truth in Lending disclosure, the final TIL, and the RESPA HUD-1 settlement statement, the HUD, or HUD-1, are now combined into the new closing disclosure. A summary of the rule and the rule itself are available on the Bureau's website at consumerfinance.gov/regulations. Moving to this next slide, I want to show some of the tools that you can use to more fully dig into the new rule. We have created several resources to assist with implementation. If you have not already explored them, I encourage you to do so. Here's a screenshot of the CFPB Regulatory Implementation webpage. We provide implementation resources for all of our rules, and as you can see here, you can select the TILA-RESPA Integrated Disclosure Rule and then drill down further. And here's a list of resources to help you comply. We have a compliance guide. This is a plain language guide in a frequently asked questions format. We have a guide to forms. This provides detailed instructions for lenders to complete the loan estimate and the closing disclosure. And we have a closing fact sheet. This provides an overview of the limited circumstances when changes to the loan require a new 3-day review. And here's a link to the website. I've gone through the first 3 items already. And to continue, the website also contains a disclosure timeline illustration. This provides a sample real estate purchase transaction. The transaction includes a number of events so that it can be used to explore required timeframes when there are changes to transactions. The illustration includes an addendum to the purchase contract, a low appraisal, a rate lock after the initial application, and a broken dishwasher. It isn't meant to represent a typical transaction. It presents multiple events that might occur and walks through those as examples. And we have a readiness guide, which is part of the supervision and examination materials. The readiness guide provides guidelines for institutions to evaluate their readiness and to help them comply with the mortgage rule changes. And we also have a link to a series of webinar videos that address the implementation of the new rule. There are 5 presentations available that go over the loan estimate, the closing disclosure, and many questions that were submitted to us. The webinars were held in June, August, October, and November of 2014, and then additionally in May of this year. There's also a question index that provides a summary of and a reference to many questions that were addressed within the webinars. Last but not least, I want to highlight the e-regulations tool. This is a resource created by the Bureau to make regulations easier to find, read, and understand. It does not include all regulations. In fact, it includes only 2, but it does include Regulation Z. Many people have told us that they have found this to be a great resource, so I strongly encourage you to check it out. It allows the reader to scroll down through the sections of the rule and to open and view the official commentary alongside the text of the rule. And now I want to turn things over to my colleague Pedro to start to discuss the substance of the new rule.
Thanks, Julie. All the tools you just mentioned are a great help for understanding the know before you owe mortgage rule. I also want to reiterate the disclaimer you gave earlier, which is that ultimately the text of the rule speaks for itself. That rule text is in the Code of Federal Regulations under Title 12, Part 1026. That's abbreviated as 12 CFR 1026. As we're talking and on some of our slides, we'll refer to different sections and paragraphs of 12 CFR 1026. With that background, let's talk about what loans the rule does and doesn't cover. The know before you owe rule doesn't apply to reverse mortgages or to home equity lines of credit. The rule also doesn't apply to mobile home loans unless the loan is secured by real estate, which is a question of state law. Those are common examples, and there are some less common exclusions. We've received a question about one, and we'll discuss it later during the Q&A period. The rule doesn't apply to loans with applications before the effective date. The effective date was originally August 1st, 2015, but it was recently changed to October 3rd, 2015. The CFPB website has a press release and other information about that date change. So consumers with applications received on or after October 3rd, 2015 will receive the new disclosures. Consumers with applications before October 3rd, 2015 will receive the current GFE, initial till, HUD-1, and final till disclosures that Julie mentioned. The know before you owe rule defines the word application. An application occurs when a consumer submits and the creditor receives 6 pieces of information. 1, the consumer's name. 2, the consumer's income. 3, the consumer's social security number so that the creditor can obtain a credit report. 4, the property address. 5, an estimate of the value of the property. And 6, the mortgage loan amount sought. On or after October 3rd, 2015, once a creditor receives the 6 pieces of application information, a creditor then has a 3 business day deadline for delivering or placing the loan estimate in the mail. What about other information besides the 6 defined elements of an application? Well, before providing a loan estimate, a creditor can ask a consumer to voluntarily provide more than just the 6 pieces of application information. But the creditor cannot require more than the 6 pieces before providing a loan estimate. And the creditor cannot require any supporting documentation before providing a loan estimate. For example, a creditor can ask 21 questions, but if the consumer provides the 6 pieces of information specified by the rule, then the creditor must provide a loan estimate, even if the consumer doesn't respond to the creditor's other questions. Another example is that a creditor can ask a consumer to voluntarily provide documentation, such as pay stubs or bank account statements, but the creditor can't require any documentation before providing a loan estimate. Again, once a creditor receives the 6 pieces of application information, a creditor must provide a loan estimate. That being said, the more information a consumer provides with an application, the more reliable the loan estimate may be. Keep in mind that in certain circumstances, the know before you owe rule may allow creditors to revise the loan estimate if the creditor later receives new information. By voluntarily providing more information at the time of application, consumers may reduce the chance of fees being revised. Nonetheless, it's the consumer's choice whether or not to provide more than just the 6 pieces of application information. The creditor cannot require more information before providing the loan estimate. Next slide, please. The loan estimate is not a pre-approval or a pre-qualification. As I noted earlier, creditors can't require documentation before providing a loan estimate. But the know before you owe rule didn't make any changes to pre-qualifications or pre-approvals. The consumer voluntarily provides documentation and asks a creditor to review and consider that documentation to provide a pre-qualification or pre-approval. The creditor can accept and review that documentation. The creditor isn't obligated to provide a loan estimate until it receives the 6 defined elements of an application. For example, if the consumer requests a pre-approval or pre-qualification and provides 5 of the 6 elements of an application, but doesn't provide a property address, then the creditor isn't obligated to provide a loan estimate. Once the consumer provides all 6 defined elements of an application, the creditor has a 3-business-day deadline for delivering or placing the loan estimate in the mail. The fact that a consumer requested a pre-approval or pre-qualification will not change the creditor's obligation to provide a loan estimate. Now let's take a look at the loan estimate form itself, and I'll pass it back to Julie.
Okay. Here we are showing the before forms for the beginning portion of the transaction. There are currently 5 pages of mandatory disclosures. The initial truth in lending disclosure is 2 pages, and the good faith estimate is 3 pages. And here is the after. With the new rule, we have the loan estimate, which is 3 pages. We've reduced the total pages from 5 down to 3. Prior to proposing any changes, the Bureau engaged in extensive consumer and industry outreach for more than a year. Then, after issuing the proposed rule, the Bureau conducted additional usability testing. The testing found that the new forms performed better. Consumers understood more about their transaction with the new form. Going deeper into the form, this is the first page of the loan estimate. As you can see, this form is annotated with the corresponding paragraphs in 1026-37 that address the specific disclosures required on the loan estimate. This annotated form, along with other sample forms, can be found on the Bureau's TILA-RESPA Integrated Disclosures Rule Implementation webpage. Consumer testing focused upon learning what information consumers found most helpful or relevant when shopping for a mortgage, and that information was placed on the first page of the loan estimate. The top of page 1 of the loan estimate includes general information about the loan. This includes basic information like the loan terms, purpose, product, loan type, and information about the applicant. You also have the rate lock and expiration field. This is a disclosure of whether the rate is locked, and if so, when the rate lock will expire. And it also includes a disclosure of when other estimated costs may expire. Next, you have loan terms. This provides information about the specific loan terms, such as the loan amount, interest rates, monthly principal and interest, and statements regarding whether the loan includes a prepayment penalty or balloon payment. The projected payments table is also on page 1. This will show the payment schedule for the loan and how a consumer's payments may change. In addition to showing the changes to periodic payments, the bottom of the projected payments table shows the total amount due for property taxes, homeowners insurance, homeowners association and similar charges, and certain insurance premiums or charges. Keep in mind that these are estimates based upon the best information available to the loan officer at the time the loan estimate is issued. If the loan officer doesn't know about a condominium fee, for example, that detail wouldn't be here. The bottom of page 1 of the loan estimate includes disclosures related to costs at closing, including estimated closing costs and estimated cash to close. This provides an estimate of the amount of money a consumer needs to close the loan. And finally, at the very bottom of page 1 is a reference to the Bureau's website.
Thanks, Julie. I'll discuss page 2 of the loan estimate. Let's start at the bottom. Next slide, please. If the loan's interest rate can increase after closing, then the lender must include the adjustable interest rate table near the bottom right of the page. The adjustable interest rate table lists various details, including the minimum and maximum interest rate. Certain other payment features, if any, are disclosed in the adjustable payment table near the bottom left corner of the page. For example, this table would disclose interest-only payments. Next slide. Also on the right side of page 2 is the Calculating Cash to Close table. This table provides consumers with a line-by-line estimate of the cash they'll pay or the cash they'll receive for closing. This is additional detail on top of the summary that was given on page 1 that Julie mentioned. Most of page 2 is for listing the various closing costs associated with the loan. These costs are generally broken down into two groups, loan costs and other costs. Loan costs are on the left side of the page, and the other costs are on the right side. Loan costs are broken down into three subcategories. 1, origination charges. 2, third-party services that the consumer cannot shop for because the creditor selects the provider. And 3, third-party services that the consumer can shop for. For example, the creditor might require a pest inspection but allow the consumer to shop for the pest inspector. On the right side of the page, other costs are broken down into 4 subcategories. 1, taxes and other government fees. 2, prepaid costs. 3, the initial escrow payment at closing. And 4, the other category, which covers costs that are not required by the creditor. For example, the other category may include owner's title insurance. All of these costs are included on the loan estimate based on the best information reasonably available to the creditor at the time the loan estimate is provided. Next slide, please. I'll highlight a change between the current GFE form and the new loan estimate. Lender credits can help consumers cover closing costs, and creditors sometimes provide consumers with lender credits in exchange for choosing a higher interest rate. On the current GFE, if a creditor provides lender credits for choosing a higher interest rate, then that lender credit is included as part of the disclosed origination charges, as you see here on the screen. Next slide. But on the loan estimate form, any lender credits are disclosed in Part J, titled Total Closing Costs, on the right side of page 2, and not in Part A, Origination Charges, on the left side. So, when comparing different loan estimates, in addition to considering the loan costs on the left side of page 2, remember to also consider lender credits on the right side. Moving on to page 3, we'll start at the top with the next slide. Starting at the top, there's contact information for the creditor and loan officer. Under the Comparisons heading, there's the annual percentage rate and some other metrics that you can use to compare different loan offers. As you review these numbers on page 3, you'll also consult page 1 to see if and how the interest rate and payments can change. Under the heading Other Considerations, there are various legally required disclosures, such as whether the creditor will require an appraisal or will allow for an assumption of the loan. And finally, there is an optional signature box that a creditor can include for confirming receipt of the loan estimate. Now that we've taken a look at the form itself, let's talk more about the process. Julie?
Thanks, Pedro. As home ownership counselors know extremely well, home buyers who actively seek out information in advance are going to have the best experience. Home buyers who know about their credit score and who have defined for themselves how much house they want and can fit into their lives are going to be in the best position for successful home ownership. Home ownership counselors need to also know that home buyers will be best served if they are able to go into the loan estimate stage with a specific opinion about what type of loan program they would like to request loan estimates for. Creditors will typically only issue loan estimates after the consumer has identified a property. That is one of the elements for an application. If the consumer waits until the loan estimate stage to ask about different programs, they may miss the opportunity to effectively compare loan estimates. But if they're ready, for example, if they know they want a conventional loan with a 5% down payment and not an FHA loan, or vice versa, they can easily request multiple loan estimates from competing lenders without submitting any documentation and compare apples to apples. By comparing the same kind of loan across different lenders, clients are more likely to find their best deal. Having said that, be aware that creditors are not required to issue loan estimates with locked interest rate commitments. If the interest rate is not locked, the rate and any rate-related fees or lender credits can change later with a revised loan estimate based upon the borrower's request to lock. So this is a variable that home buyers will need to know when they're engaging in the shopping process. Next, I want to talk about the intent to proceed and the collection of fees during the application process. Lenders are currently required and will continue to be required to wait until the mortgage applicant has indicated that they would like to proceed forward with their application based upon the written terms offered before the mortgage lender can collect any application or appraisal fee. The only exception is a reasonable fee for the credit report. The new rule strengthens this requirement by prohibiting lenders from collecting payment information in advance and prohibiting lenders from interpreting silence as an intent to proceed. Right now in the marketplace, some lenders collect credit card information or a post-dated check to be processed after the borrower has been sent a GFE. In that situation, the lender typically takes an application, later creates and sends the GFE, and then after the borrower has actually received or can be presumed to have received the GFE, processes the payment without further communication to or from the mortgage applicant. The new rule makes clear that this is not permissible. Lenders cannot assume that silence indicates an intent to proceed. A creditor cannot collect fee payment information from a consumer prior to the creditor delivering or placing in the mail a loan estimate and the applicant actively expressing that they intend to proceed with the mortgage application connected with the loan estimate. The only exception, again, is a reasonable fee for the credit report, and if credit card information is collected to pay for a credit report, it must be resubmitted to be used for other fees. As to the mechanics, creditors can define as a part of their business policies the steps required of a mortgage applicant for the intent to proceed to be effective. For example, they might require the payment of an application fee or the submission of a completed package of application documents, or both. Homeownership counselors working with clients will want to understand and assist their clients with understanding whether or not the requirements of the creditor for an intent to proceed have been met. One of the reasons this step is important is that loan estimates expire after 10 business days without an active intent to proceed from the borrower. Meaning, after a loan estimate expires, creditors are no longer required to honor the terms offered. And a practical concern, a potential homebuyer who has not followed up with their lender about their intent to proceed may be under the mistaken impression that they have an active application. Without an indication from the mortgage applicant that the applicant wanted to move forward from the loan estimate stage, the lender may have closed the file out as incomplete. The important thing to know about the mechanics here is that lenders are not allowed to attempt to collect fees until after the intent to proceed has occurred, and they are allowed discretion as to what they choose to require the borrower to do to express that intent. The more homebuyers understand about that process, the more empowered they will be. And now we want to move back to the form and examine the closing disclosure. Here, once again, we are showing the before forms for the closing portion of the transaction. There are currently 5 pages of mandatory disclosures. The final truth in lending disclosure is 2 pages, and the HUD-1 settlement statement is 3 pages. And then here we have the after. We now have the closing disclosure, which is a total of 5 pages. Again, the format of the closing disclosure was based upon initial consumer testing that told us what consumers found most useful. Then further testing confirmed that consumers understood more about their transaction with the redesigned new closing disclosure form. Digging into more detail, here is page 1 of the closing disclosure. The closing disclosure is a longer form with additional disclosures and information that is not on the loan estimate. Page 1 of the closing disclosure closely mirrors page 1 of the loan estimate. Like page 1 of the loan estimate, page 1 of the closing disclosure highlights the most important loan information that consumers readily understand and use to evaluate their loan. And here at the top, as with the loan estimate, page 1 of the closing disclosure shows the loan terms, purpose, product, loan type, and information about the applicants. It also includes information about the settlement agent and about the seller. And toward the bottom of page 1 of the closing disclosure, we show the estimated total monthly payment. The biggest difference between this portion of the closing disclosure and the same section in the loan estimate is that these numbers are no longer estimates. The lender has processed the transaction, and all items that should reasonably be known about the property should be reflected here. Back to the condominium fee example. If the appraiser informed the lender that there is a monthly condominium fee, the lender would now know about it, and it should be reflected here. It would be shown under the estimated taxes, insurance, and assessments section. It would not be shown in the estimated escrow section if, as is typical with condominium fees, it is paid separate and not collected through an escrow account. The bottom of page 1 shows the total closing costs and the actual cash to close.
The second page of the closing disclosure looks a bit different than page 2 of the loan estimate, but it has similar information. One key difference is that on the closing disclosure, different columns show who paid the charge, the borrower, the seller, or others, such as the creditor. The columns also show whether the charge was paid at or before closing. If the lender pays for specific closing costs, that will be disclosed in the Paid by Others column on the right side. If the lender also provides non-specific lender credits that are not associated with any particular item, those general lender credits are listed at the bottom of page 2. When costs are higher on the closing disclosure than on the loan estimate, in some instances, the lender may be obligated to provide some refund. If the lender is providing a refund, there will be a note on the lender credits line at the bottom of the page stating that a refund of X dollars is included. Moving on to page 3 and the next slide. The top of page 3 contains a calculating cash to close table, which is compared with information on page 2 of the loan estimate. It shows if amounts at closing changed from the amounts on the loan estimate. Next slide. Page 3 also has a summary of transactions table, which resembles the current HUD-1.
And here's page 4 of the closing disclosure. The top of the page contains a number of disclosures under the heading Additional Information About This Loan and the subheading Loan Disclosures. Specifically, page 4 contains the following disclosures: information concerning future assumption of the loan by a subsequent purchaser, whether the legal obligation contains a demand feature that can require early payment of the loan, the lender's policy for charging of late fees, whether regular payments can cause the principal balance of the loan to increase, creating negative amortization, the lender's policy in relation to partial payments by the consumer, a statement that the consumer is granting a security interest in the property along with an identification of the property, and information related to any escrow accounts held by the servicer, or a statement that an escrow account has not been established with a description of estimated property costs over year 1. There's also a box indicating what escrow waiver fee, if any, was charged. If an escrow waiver fee was charged up front, it would have also been disclosed in loan costs under origination charges. And the bottom of the page, in the case of adjustable payments and adjustable interest rate programs, the forms show details relevant to those scenarios. These tables are not used in transactions that do not have adjustable payments or adjustable interest rates. Page 5 is the last page of the closing disclosure. The contents of this page are loan calculations, other disclosures, contact information, and an optional signature line to confirm receipt. And here's the top of page 5. Loan calculations are roughly the amounts disclosed currently on the Truth in Lending Statement, plus the new total interest percentage, or TIP, added by Congress in the Dodd-Frank Act. The TIP is the total amount of interest that a consumer will pay over the loan term as a percentage of the loan amount. One thing to know about the tip is that it tested well with consumers. Consumers understood the concept and found it useful. Other disclosures on this page contain information required by a few other federal laws, including information regarding appraisals, contract details, liability after foreclosure, refinancing, and tax deductions. At the bottom of page 5, contact information is provided for the future reference of the consumer and the seller. It includes contact information of several parties associated with the transaction, namely the lender or creditor, mortgage broker, real estate brokerages, and the settlement agent. And finally, page 5 contains an optional signature line that can be used to document that the closing disclosure was received by the consumer.
Thanks, Julie. Now that we've taken a look at the form itself, let's talk more about the process. A creditor may contract with a settlement agent to provide the closing disclosure on the creditor's behalf. But even so, the creditor remains responsible for the closing disclosure. The consumer should receive the closing disclosure no later than 3 business days before consummation. This is an important part of the Know Before You Owe rule because it gives the consumer additional time to review the disclosure and to ask questions about it before committing to the loan. The creditor can deliver the closing disclosure to the consumer in person or by other means, for example, by courier with a signed and dated delivery receipt. If the creditor doesn't want to worry about getting evidence of receipt, it can also put the closing disclosure in the mail extra early and presume that it's received 3 business days later. For example, if consummation is scheduled for December 30th, 2015, and the creditor puts the closing disclosure in the mail on December 22nd, the creditor can presume that it's received on December 26th. Note that the 3 business day period is based on the date of consummation, which is defined as the time that a consumer becomes contractually obligated on a credit transaction. The consummation date can be the same date as the closing date, but it isn't always. The timing of when a consumer becomes contractually obligated depends on state law. If the creditor delivers or mails a closing disclosure, and then something changes, the creditor must provide a corrected closing disclosure to the consumer. Unlike the initial closing disclosure, which the consumer must receive at least 3 business days before consummation, for a corrected closing disclosure, it's typically fine for the consumer to receive it at closing. There are only 3 changes that would require a new 3 business day review for a corrected closing disclosure. 1, if the annual percentage rate increases by more than 1/8% for most fixed rate loans, or by more than 1/4% for most adjustable rate loans. 2, if a prepayment penalty is added. And 3, if the basic loan product changes, such as a switch from fixed rate to adjustable rate, or switching to a loan with interest-only payments. Unless you have one of those 3 changes, the creditor can provide the corrected closing disclosure to the consumer at closing. That being said, if the consumer wants to, the consumer always has a right to inspect the closing disclosure on the business day before consummation. Now that we've discussed the loan estimate and the closing disclosure, let's discuss CFPB materials that you can share with your clients. Julie.
Great. Thanks, Pedro. And now I want to talk about materials that homeownership counselors are encouraged to adopt and to actively use with your clients. We released Your Home Loan Toolkit in April 2015. Lenders are required to provide this document to mortgage applicants within 3 days of application. We'd like potential home buyers to receive it even sooner if possible. And with that goal in mind, we encourage all industry participants to share the toolkit early and often. Your Home Loan Toolkit is the updated version of the HUD Settlement Cost Booklet. Whereas the HUD Settlement Cost Booklet was 78 pages and at an 11th grade reading level, we were able to bring the toolkit down to 26 pages and a 7th grade reading level. Your Home Loan Toolkit suggests a framework for readers to define what affordable means to them, with tools to help them understand their credit, pick the mortgage type that works for them, choose the right down payment, understand the trade-off between points and interest rate, shop with several lenders, choose a mortgage, and then avoid pitfalls and handle any problems that might arise. The toolkit also provides guidance for shopping for mortgage closing services, reviewing any revised loan estimates that consumers may receive, and understanding a closing disclosure. Here's a link to the CFPB Learn More page where you can download copies of the toolkit in PDF format. A Spanish language version is also available. And if you would like to use your logo on the front cover of the toolkit, there are instructions for how to do so here. Another resource offered by the CFPB is the Owning a Home website. It provides a full suite of online tools and resources for prospective home buyers. We encourage you to explore the site and to consider sharing it with clients.
Great. Okay. Well, thank you so much again for everyone for participating in today's webinar and offering your thoughtful questions. You can feel free to contact me at alicia.criado@cfpb.gov. Again, that's alicia.criado@cfpb.gov. If you have any additional questions or if you'd like to provide us with feedback regarding today's presentation. Take care, and I hope you all have a wonderful day.
That concludes today's call. Thank you for participating. You may disconnect at this time.